What if I told you that one of the greatest investors in American history never went to college, never worked on Wall Street, never picked a hot stock? His name was Ronald Read. Ronald Read spent his entire career working as a gas station attendant and a janitor in Vermont. He drove a used car. He wore a coat held together with a safety pin. His neighbors had no idea. But when Ronald Read passed away in 2014, he left behind $8 million. Not from a lottery win, not from an inheritance, not from a side hustle that went viral. He simply saved consistently, invested in companies he understood, and let time do the heavy lifting. So if a janitor from Vermont can do it, what's stopping you? Welcome back, everyone. If you're new here, I'm so glad you found this channel. We talk about wealth, money psychology, and building the mindset that actually gets you to financial freedom. And today, we are going deep into one of the most powerful books I've ever read on money, The Psychology of Money by Morgan Housel. This is not a book about spreadsheets or stock formulas. This is a book about behavior, about how your mind works with money, and how to make it work for you. I've pulled out the 5 most life-changing takeaways from this book, and I'm going to break them down in a way that actually makes sense for your life, right here in America, right now. So stay with me for the next 30 minutes. This video could genuinely change the way you think about money, forever. Let's get into it. All right, rule number 1. And this one is going to reframe how you look at the stock market forever. Imagine you walk into a Rolex store. You see a beautiful watch. It's everything you've ever wanted. It makes a statement. Now you have 2 options. Option 1, you pay for it. You swipe your card. You walk out proud. Option 2, you grab it and run. Now obviously, you're going to pay, because you know that owning something valuable comes with a price. That's just how the world works. Here's the thing most people miss. Investing has a price too. And that price is not money. That price is volatility. It's the stomach-dropping feeling when the market falls 20% in a month. It's watching your retirement account lose $30,000 in a week. It's the Sunday night anxiety when you check your portfolio and it's down again. That discomfort is the price of admission. Let me give you a real American example. Let's say you invested in Netflix back in 2007. You believed in streaming before anyone else did. You were smart. You were early. By 2021, that investment would have made you unbelievably wealthy. But here's what they don't put in the headline. In 2011 alone, Netflix lost 800,000 subscribers. The stock crashed 80%. 80%. Could you look your spouse in the eyes after that? Could you hold on while your friends told you to sell? Could you sleep at night knowing your kid's college fund was tied up in a stock that just tanked? That is the price. And most people are not willing to pay it. And it's not just individual stocks. Even the safe play has a price. If you invested in an S&P 500 index fund starting in 1980, one of the best long-term investments in history, you still would have experienced about 13 years where your portfolio was down 20% or more from its high, and about 8 months where it was down 50%. 13 years of doubt. 13 years of your brother-in-law telling you to sell. 13 years of news anchors screaming that the end is coming. But the people who stayed? They won. So here's your mindset shift from rule number 1. Stop thinking of volatility as a threat. Start seeing it as a toll you pay to get to wealth. Don't try to avoid the price. Don't panic sell. Don't try to time the market to skip the pain. Just pay the price. Because the returns are worth it, if you can hold on long enough to collect them. Rule number 2, and this one is going to make you uncomfortable, in the best possible way. Let me paint you a picture. Meet Dr. Bill. Bill is a highly specialized surgeon in Chicago. He earns $500,000 a year. He drives a BMW. He takes his family to the Maldives every summer. By every normal standard, Bill is rich. And for years, Bill felt great about his life. Until he bought a vacation home in the Hamptons and discovered his neighbor was Stan. Stan is the CEO of a publicly traded company. He earns $10 million a year. He has a private chef, a helicopter, the works. Now, Bill doesn't feel so rich anymore. But here's the twist. Even Stan isn't satisfied. Because Stan grew up with Michael Jordan. And compared to MJ, Stan's $10 million a year feels like pocket change. And Michael Jordan? He occasionally attends events where Jeff Bezos shows up. Bezos made more money in a single day in 2020 than most Americans make in their entire lives. There is always a bigger fish. Now here's why this matters for your money. Social comparison, comparing your wealth to others, has led some of the smartest, most successful people in America to make absolutely devastating decisions. People have lost their marriages, lost their freedom, lost their dignity, all chasing a number that kept moving. The hardest financial skill is getting the goalpost to stop moving. So how do you fix this in your own life? You define enough on your terms, not your neighbor's terms, not Instagram's terms, not your college roommate's terms. Ask yourself these 3 questions. What does financial freedom actually look like for my life? What am I willing to risk? And what am I not willing to risk? What would I regret more? Missing out on more money or losing what I already have? Because here's the truth that nobody talks about on social media. Enough is not a number. Enough is a feeling. And if you build a life where you genuinely feel grateful for what you have, where you don't need more to feel okay, you have already won the money game. Rule number 3. And this one is going to make you a more empathetic investor and a smarter one. Have you ever looked at how someone spends their money and just thought, that's insane? Maybe it was the neighbor who blew their tax refund on scratch tickets. Maybe it was the coworker who drives a luxury car but can't pay rent. Maybe it was the family member who refuses to invest in anything, just keeps cash in a savings account earning basically 0 interest. Here's what Morgan Housel wants you to understand. Nobody is crazy. They're just working from a different map. Let me give you a powerful, real-world example. In the United States, the lowest income households spend an average of over $400 a year on lottery tickets. That's 4 times more than the wealthiest households. And at the same time, more than 1/3 of Americans cannot come up with $400 for an emergency. So at first glance, it looks completely irrational. But wait, let's think about this differently. Imagine you're working 2 jobs. You're living paycheck to paycheck. Every time you try to save, something breaks. The car, the furnace, the phone. You don't have access to a 401k through your employer. You never learned about index funds growing up. Nobody in your family ever talked about compound interest. A lottery ticket isn't stupidity, it's hope. It's buying the dream of a better life, the only dream that feels accessible right now. So what does this teach us as investors? Number 1, stop copying other people's portfolios just because they seem successful. A billionaire keeps 90% of their wealth in ultra-safe assets because they're focused on staying rich. You, if you're still building wealth, might actually need more risk, more growth investments, more time in the market. Copying Warren Buffett's portfolio in your 30s might actually be the wrong move for you. Number 2, invest only in what you understand. Remember GameStop in 2021? Millions of Americans jumped in because they saw people making money on Reddit. Some won big, most lost. If you don't understand the game, don't play it. That's not fear, that's wisdom. When you truly accept that different people operate from different maps, you stop judging them. And more importantly, you stop letting their moves distract you from yours. Stay your course, trust your map, and let others walk theirs. Rule number 4. And this one is going to make you rethink every financial prediction you've ever taken seriously. Quick quiz. What did the Great Depression, Black Monday in 1987, the 2008 financial crisis, and COVID-19 all have in common? Nobody saw them coming. Not the economists, Not the hedge fund managers, not the talking heads on CNBC, not your financial advisor. Nobody. These are what author Nassim Taleb calls black swan events. A black swan is impossible to predict in advance. It has a massive impact when it happens, and it seems completely obvious after it happens. The third part is the sneaky one. After 2008, everyone said, well, obviously the housing market was a bubble. After COVID, everyone said, of course a pandemic was going to hit eventually. Obvious in hindsight, invisible in foresight. Here's a stat that will blow your mind. If you invested in the S&P 500 over a 20-year period, but you missed just the 4 best performing days in the market, your return would drop from 291% down to 164%. 4 days out of 7,000. That's how much those unexpected moments matter. And here's the thing. Nobody knew those would be the best 4 days before they happened. They often come right in the middle of the worst crashes. So what does this mean for you? Stop listening to the person on YouTube or TV who says the market is going to crash in Q3. They don't know. Nobody knows. Instead, focus on 3 things. Keep an emergency fund of 3 to 6 months of expenses. Never invest money you can't afford to lose short term. Diversify enough so that no single event destroys you. Your goal is not to predict the storm. Your goal is to build a boat that can survive any storm. The investors who win over the long run aren't the ones who saw 2008 coming. They're the ones who survived it and stayed invested through the recovery. That's who you want to be. And now we get to rule number 5. And I want you to really think about this one, because it's affecting your financial decisions right now, even if you don't realize it. Let me try something. I'm going to give you 2 arguments about the U.S. economy. Because for our ancestors, missing a threat could mean death. Missing an opportunity? Just an inconvenience. And there's another reason pessimism sounds smarter. Progress is slow. Setbacks are fast. The 2008 financial crisis wiped out trillions in a matter of months. The recovery took years, but it happened. The COVID crash of 2020, markets fell 34% in just 33 days. The recovery hit new all-time highs by August. But which story got more media coverage? Exactly. So how do you protect yourself from this bias? 3 practical steps. When you feel fear about the market, zoom out. Look at 10, 20, 30-year charts. Limit your financial news consumption. More news does not equal better decisions. Remember, the U.S. economy has never not recovered. Every single time. The world is genuinely getting better. Poverty is declining. Technology is advancing. Opportunities are expanding. The optimists aren't naive. They're just playing a longer game. All right, let's bring it all home. You've just learned 5 rules from one of the most powerful money books ever written. Rule 1. Volatility is the price of wealth. Pay it without panic. Rule 2. Define enough on your terms before the world defines it for you. Rule 3. Other people aren't crazy. They just have a different map. Rule 4. You can't predict disaster, but you can prepare for it. Rule 5. Pessimism sounds smart, but optimism wins long term. Remember Ronald Reed, the janitor from Vermont? He wasn't a genius. He didn't have connections. He didn't have a finance degree. He just understood these principles, and he lived by them for decades. Financial freedom is not reserved for Wall Street. It's not reserved for the Ivy League. It's not reserved for people who were born into money. It is available to anyone willing to think differently about money. And that's exactly what this channel is here for. If this video gave you even one new perspective, please hit that like button. It genuinely helps this channel grow and reach more people who need to hear this. Subscribe to Success Mindset so you never miss a video. And pick up The Psychology of Money by Morgan Housel. It's one of the best investments of $15 you'll ever make. I'll see you in the next video. Keep building, keep growing, and remember, your mindset is your greatest asset. Take care, everybody, and subscribe our channel to get more video.